Good morning. The title for today is When the Fed Tightens, Bubbles Often Burst. And I want to start by saying that is factual. I'll show that, but it's also doesn't mean there aren't some really good opportunities, and want to talk about that because I think this is one of those times where you can get caught flat-footed and unaware, and you can make some really bad decisions. So we'll just give you some perspective there. It's clearly been a tragic year for the world with the war and with the pandemic continuing to go on. But it's also been a fascinating year from economic and investment perspective. We've seen losses in global equities of 11 to 12 trillion. Cryptos have been cut in half. On Bitcoin, you've had 40% of the owners of cryptocurrency now are underwater on their investment. You have stable coins not being very stable, interest rates moving up 2%, which on a 30-year bond would be about a 18 to 30, about a 31% or 35% loss. On the 10-year, you've lost about 18% on paper. Inflation continues to run hot, but we've had a lot of dislocations going on. So today I want to cover three things. Our thoughts on moving from quantitative easing to quantitative tightening and what that means. Discuss inflation a bit, and then talk about investing in a tightening cycle. So throughout the last 60, 70 years, we've had a number of times when the Fed has tightened. And to give you a sense, the red is shaded areas are tightening periods. The blue shaded areas are easing periods for the Fed. And for those who have been around a while, you remember the 80s, we had a series of crises as the Fed went through their tightening period, and then back into the 90s when we had the Asia crisis and other areas, then the tech bubble and LTC. And so we've had a number of issues. This is the Fed look at it. I also just want to keep perspective because when you look at crises in the S&P, it is a comment about patience and the value of the public equity markets and providing stable and steady, consistent returns. And I think the average annual returns now have moved up to around around 9 to 10%. So you've seen a lot of opportunities, but there are potentials for bubbles blowing up around the world. I don't think there's a big issue in the U.S., and I'm not sure that the bubbles, unless there are a massive debt issue, are going to really be meaningful. But I think some of the areas you could see you're seeing bubbles in are obviously crypto, but also the Russia potentially having a financial crisis. China and the emerging markets tend to be where the problems exist when the U.S. raises rates, and the pain is usually felt in emerging economies, particularly those that are high emerging market debt that are in dollars. Their interest costs go up, and the S&P clearly has had a bear move to bear market with the Nasdaq in a bear market. And you could also have a bubble blow up in oil with oil prices rising. You know, some have projected up to 150. We're not in the camp that all these things are going to go bad, but it is likely that some bubble is going to burst somewhere, and it's going to have some meaningful pain for people. But on the other hand, as we move from quantitative easing to quantitative tightening, you've seen multiples come in. And these numbers are pretty staggering when you think about the changes that have gone on. And the S&P started the year at about a 21.5 multiple. It's now down to about a 17.1 multiple. You've had the mid cap go from is now down to around a 12.5 times multiple on forward earnings. And the S&P 600 or the small cap index down to 1.9. These are really major moves in a relatively short period of time. I think that is something that's noteworthy because a lot of the damage that people are concerned about now has already been done. And when you look at it a different look and add to it the mega cap 8, which this is from Ed Yardeni, and I appreciate him allowing me to use this, but the mega cap 8 is Alphabet, Amazon, Apple, Meta, Microsoft, Netflix, NVIDIA, and Tesla. And those stocks have gone from a multiple of around 34 at the beginning of the year, or 32 at the beginning of the year, down to 24 So pretty significant re-rating's gone on in a lot of areas. So I'll come back to a little bit later why I think this is a time to be thoughtful, but also to be taking advantage of some of the gifts that have been given us. So we'll talk about that. We touched on Bitcoin and the changes there, and you guys know this area better than I do, but a couple things jump out to me about Bitcoin. It has had a pretty dramatic move in the last 2 weeks, obviously, but it hasn't proven to be particularly non-correlated to equities lately. The correlations, the journal has a piece on that today, show the correlations moving up pretty considerably in this stress period that we've been in. It also hasn't been a particularly good inflation hedge in the short term. And I'm saying this all short term, so take that for the people. I don't want to offend anybody here, but I think the bigger concern is the stable coins not being very stable, and not necessarily Terra, which is down to 11 cents or something, but that Tether was down about 5 cents. And whenever you have things that are supposed to be stable not being stable, and we saw this with the money markets years ago, it creates a big problem. And I think the other issue that we're still facing is it's not great for everyday transactions, not for big ticket items, but for everyday transactions. So some of the utility arguments are still being challenged. I think there's other issues that make this very attractive as well. So, but I think the jury's out. I still remain in the camp as a skeptic, but I have to believe with the money that's been attracted there, and with people willing to step in at lower prices and buying on dips, there may be some rallies coming in a lot of areas in the short term. Let's shift to inflation now and touch on that. We know that inflation's high, but if you look at this chart pretty carefully, and I just want to go to right around where the April is in both, you can see a hook down, and the red is headline inflation, slight hook down, core inflation, a bigger hook down. And I think that's something to keep an eye on. Clearly, inflation is elevated, and but there is growing questions about, is it peaking, and are we seeing areas where it is peaking? And we've seen some pretty material moves in the 1 month period in headline and core. Headline in the 1 month is down by 0.2%. Core is down 0.3%, which when you're running 8% and 6% numbers is not all that great, but it is meaningful to keep it on. Is this the start of a flat reversion that things got a little too hot too fast? And that some of the efforts being done by central banks to quell inflation, the rate moves and the tightening that's already gone on, is starting to have an effect. But it is elevated, but one of the reasons it might be peaking, there are several. I would focus on the slowing global growth. M2 has come in quite a bit. The US dollar has been particularly strong. That makes our numbers look a little bit better in that area. Wage price might be peaking. I don't know if you've seen in the couple publications, Wired and one of the other papers is talking about startups, tech startups starting to have layoffs. I think bigger tech companies are also starting to see some layoffs. So I think that's going to ease some of the wage inflation pressures that have been going on as that continues. So we could be in a sideways market for some time, but something to keep an eye on. Looking at inflation from a different perspective, this is durables in the red, non-durables in the blue, and services in the green. And I'd point out a couple numbers that really jumped in the last month. Airlines saw a 35% jump, hotels saw a 23% jump, and electricity 11% jump. That's part of what's fueling the services side from there. But you also are seeing used cars come back in quite a bit in other areas. So there are still big pockets of inflation that are up. Rent is at a 5% rate year over year. You're seeing baby formula problems, egg problems, EU gas problems, which we know. The global food issue is still a big one. And you're also, now that the airlines are coming back, seeing pilot shortages that exist today. So a number of challenges that exist out there. So I want to shift to investing in a tightening cycle. And I touched on this last week, but I think there's 3 premises that are really important for you to keep in mind here. You want to focus on quality. As rates move up, liquidity is becoming a bigger issue. And I think you may see some liquidity squeezes in some big corporations, particularly some of the ones that are kind of got way ahead of themselves on market expectations, and now we're seeing sudden reversals in their earnings could have some real challenges for attracting capital in this kind of a market, and raise their borrowing cost up considerably. And I think you also want to keep duration short on your fixed income side and be really thoughtful about where you're placing your money, which you always should be. But quite frankly, the Fed put that existed as they kept stepping in and lowering rates, where they were very concerned. And this, Lauren, is one of your points about Bernanke. The Fed was very concerned about the stock market. I don't think they're going to be as concerned about the stock market as they have been in the past. They need to tame inflation. They have confidence that the market has moved up quite a bit and can pull back some and still be fine. I think they're really less worried about employment right now, and their focus is going to be very heavily on inflation. And there are beneficiaries of the inflation that you can participate in the markets. I still remain that you want to be with equities over bonds, strong balance sheets over weak, and long over short. But I also think there's a couple reasons you want to be thinking about equities now differently than you have maybe even a couple months ago. I think much of the risk in the market, particularly on rate moves and all that, is priced in already. Valuations have adjusted. As we talked about, the multiples have come in quite a bit. And we think that's a multi-point move in a quarter is really pretty impressive, and highlights that the damage is done. I also think that the market has done a good job of bringing the Fed up to their level of expectations on inflation. And that means the Fed will likely have to be less active in raising rates, and the market may be skewing a little too aggressive on the rate moves still. And I think you're starting to see some issues changing around inflation, particularly, in the past, it's been, excess demand versus low supply. The pandemic has actually created low supply issues. So this is very different than the past inflationary cycles. And in the past, the Fed and other central banks would choose to kill inflation with higher rates. I think this time they're going to focus on growth, and their battle for inflation is not bringing inflation down in a gradual way or as fast as they can, but also favoring growth, even if that means letting the markets take a hit right now. So I think this is a different dynamic that we're looking at in the past. I do think you can invest in the durable secular themes and do quite well. And the pullbacks have hit, all these areas. Commodity producers have been hit particularly hard, some justified, but those that are required for the technological advances are going to continue to be in high demand and shorter supply. The digitalization, electrification of our economies continue to go at a dramatic rate. And we've seen more and more about national security, both cyber, military, food, and energy needs rising, and the shift of people, Finland and Sweden petitioning to go into NATO again is a sign of the risks that are out there and that continue to exist today. We think biotech companies are another area. It's not without risk, but there's been significant pullbacks in a number of these. And just for a little perspective in the markets right now, around 14 or 15% of the stocks in the S&P are selling above their 50-day moving average. So if you want to get a sense of has a lot of damage been done, that is a historically low number. The AAII survey last week was also at a historic low level as well. In terms of bullishness, bearishness at a record level. So as we sit back and look at what's going on in the market today, we see a number of opportunities. And in fact, our firm was very active in doing buy programs last week to put capital to work in areas to bolster positions that we think have been well oversold. And we think that's going to continue to be a major issue. I also think you're going to see buybacks continue at a pretty high rate. I think we had 250 billion in buybacks in the first quarter, which is a pretty massive number. You'll also see companies really being aggressive, taking advantage of their pullback in their prices to buy more shares in. And we see a number of companies that are going to be able to financial engineer their way to significant outperformance coming up. So I'll leave you with the same thing we've had for a while of avoiding the extremes in valuation and focus on earnings and those who are investing in the future. That's what's going to drive stock performance. And you're seeing that as people are pulling back on their investments or guiding down on their earnings. The market has been very unforgiving, and we expect that'll continue. But likewise, we'll see a number of companies set up for pretty significant short squeezes. I would also say that we've had big sell-offs in a number of areas that have created a tag-along effect, particularly with ETFs and index funds liquidating, have taken a lot of good companies down with the bad. And this really is a time to own stocks, not the market, or own sleeves of industries, not whole sectors, because the market is going to be very discerning as we go forward. So Mark, I'll stop there and open up for questions or comments.
Thank you, Stephen. I've got a question for Stephen, for the whole group, actually. Stephen, first, as always, thank you. So not to try to be a pundit in any way, crypto digital assets, as I prefer to call them, have been thought to believe to be the ultimate anti-correlate, if you will. And it would appear that's not the case in this environment, yet gold appears to be resilient, to be that shining star amidst trouble and turmoil. Comments, thoughts? I mean, I realize there were technical factors that weighed heavily on the crypto market last week and the week before.
And I just gave a couple examples of what's gone wrong with crypto, but I would also just say that it's too short a time frame to make big, bold statements that it's not going to have low correlation or anything. But in this short window, it hasn't done what the hope would have been for it. I would just leave it at that. Yeah. Gold has been a much more, I think gold is in steadier hands and has been for a long time. People who own gold tend to own it for extended periods, or they're very short-term traders, where crypto is a lot of new investors. And if you're a new investor and you're down 40%, might not stay around long if you don't have the wherewithal to back up and average down. So I think that dynamic I would suspect that the shareholder bases in terms of demographics are quite different between the two. And I think there's been so much short-term money made in crypto that these pullbacks, if you started taking mortgages and all that on it, which some of the younger people did, they might be a little over their skis, and that's creating some short-term dislocations. I wouldn't project what's happened in the short term to what's going to happen in the long term with crypto. I just think there's too many questions still to be answered, but it's certainly the early returns would have been disappointing if you were a full believer in those areas holding through different stress tests.
Sure. Thank you. Appreciate
it. Other questions?
Yes, Stephen, thank you. This is outstanding. I do have a question when you talk about this durable secular themes. When it comes to national security and cyber and military, in that the tech sector obviously is taking quite a hit. And I guess, you have to, be careful in terms of the earlier stage tech versus other tech when it comes to the national security part of what you're saying? If you can,
Well, I would just say that the amount of investment dollars that are going to be shifting to national security around the world will be maybe the highest shift we've had in a single year ever.
Okay.
Just put it in that perspective. You think of much of the EU nation, many of the EU nations are having significant increases. I mean, Germany doubling theirs. Japan is going to start increasing theirs as well. You're looking at, Finland and Sweden now going into NATO would be committing to 2% of GDP going towards defense. So the math just means that more dollars have to flow. And if you think about the 5 largest defense companies in the US, I believe their combined market caps are somewhere between $700 and $900 billion. So if you think about the assets that are out there, that level of exposure is not very high. So it doesn't take much for the NATO nations to start to act to move the needle there. I think when you're getting into the cyber aspect of it, there's, I'd let Hamlet or others explain that better, but I think that the risks in the newer companies are the same risk in any new company, whether it's in cyber or another area of tech or another area of the market. I think the more mature companies are going to continue to do well, and I think some of these smaller companies, and that is one of the benefits of the whole tech chain, because national security is as much about tech as it is about armament these days.
Absolutely. Thank you.
Stephen, is that going to shift or pull money away from other sectors that, is it going to cause any kind of, like, let's say, shortage, so to speak, of capital in other sectors?
Lauren, whenever you have the dislocations that you have in the world today, money flows to where they believe the highest rate of return is. Always. They don't stay in an area that's a low rate of return for long and say, I really enjoy getting the low return. So money chases, capital flows the highest rate of returns, and then investors follow. So yeah, I think you'll see changes in flows, and it'll move from some areas to others. A lot of the reopening trade will, you're seeing airlines picking up and the like. So it's not just the national security. I don't know how sustainable the airline one is. I do think the national security one is going to be increasingly investable, because I think the risks of the global economy coming together are not very high, and I think we have a greater likelihood for more fracturing around blocks, trading blocks, and I think that's going to change how capital is going to flow as well. And Janet Yellen's been promoting, working with like-minded nations for, all your supply chains and everything. So I think you're going to have a bifurcated world, and that will also move capital flows considerably.
I mean, and the reason why it's a concern for me is, in a sense, what the social impact would be if you have capital flowing out of certain sectors. It could, for instance, affect deployment, or, affect various like regions maybe that are tied to certain like sectors. So that's why I'm interested in that.
Yeah, I do think we still have in the backdrop reshoring and friendshoring is what they're calling the friendshoring is when you work with like-minded nations, and is one of the themes that's going to be picking up more. So it may not always hurt the ones you think, but it will hurt, and they'll be pain. Money flows out of an area, and lending stops going to that area because they're not growing at the same rate they were growing, and it creates a trickle effect. So you do have to worry about that. It's just a question, is your interest the one that's getting hit or not?
Stephen, along those lines of national defense and the flow of money to the highest bidder, these multiples, the price multiples for high tech going from 34 to 24. I mean, these are dramatic drops. Is this more of a sobering of what future expectations are for these tech companies, or is it what's driving that price drop?
Multiple contraction starts with rates, right? You raise the rates, you change the cost of capital, and you rate the industry. That's part of it. I think the other part of it is with the Fed put, people were willing to take on more risk than they will be right now. And that's why you have lower multiples, because people aren't willing to pay up for the earning streams at the same level. And so I think it's a combination of the market got a little ahead of itself, which people were fearful of last year, but also that you've had a re-rating of multiples because of the interest rate moves. So I think the combination of those two is what really is changing the math on companies. But yeah, when you have an Apple or Amazon selling down 25% from where they were, unless you think something's materially broken with those companies, or the regulatory environment is going to be so restrictive that they can't earn, I think they're proving otherwise. Their balance sheets are, incredibly strong. Google's going to buy back $70 billion of dollars worth of shares this year. So that's probably a 5% move or more on their company in stock, after they're doing $50 billion last year and $25 billion the year before. Apple's going to do $90 billion of buybacks this year, and probably increase their dividend more as well. So these guys are really, the big ones are in a very healthy position. There are a lot of companies that are in very healthy financial positions. There are also a lot of ones that are not. And I think that's where the bifurcation will come in, and where you have to be really discerning. And I would also say this isn't just the public markets. I was mentioning to Eddie Vanderpart after lunch last week that we should have a discussion on private market valuations and what we think we would pay now versus what we would have paid a year ago, because I think the same rules apply. And as you're starting to see layoffs from some of those areas and their access to capital changing, does that shift what you're willing to take on? And I think risk profiles have changed considerably with the move up in rates and with some of the other changes that are going on in the world today.
Okay, thank you.
You're welcome.
What?
Stephen, it's William here. I wanted
Stephen,
to.
less risk or
I'm sorry.
more
Hold on
risk?
one second, Lauren.
Sorry.
Bill?
Well,
Sorry,
William?
I don't mean to interrupt you, Lauren. I just had a question, Stephen, on the electrification side.
Yep.
I'm interested particularly in the EV infrastructure. Do you have any resources that you guys look at? Like, do you go through the Biden infrastructure bill? Do you look at big tech companies, what their side projects are? Or how do you guys determine where to allocate?
It's great. We do look at government. We do look at a lot of the government stuff. We do use primary research from the government as well. But a lot of what you're getting on electrification is coming out of the different sectors, starting with the utility sector and where they're spending. Then you have companies like Quanta, the symbol PWR. Quanta Services does a lot of the electrification lines and pipelines and things like that. So we actually use multiple sources for it and pull the different themes together inside that. I do think electrification is one of the biggest issues facing the United States. And I think it's also one of the areas that we are not investing well for, and is ripe for public-private partnerships and a more focused government fiscal policy to address the needs there, because succeeding there means you're going to succeed in all your industries if you get this right. If you get it wrong, it's going to be very detrimental growth.
Well,
Thank you. Sorry about that, Lauren. Didn't mean to interrupt.
I'm just looking at the time here.
11:30.
Yeah, it's 11:30. But William, by the way, are you going to join us for lunch? You almost did a couple weeks ago.
Yeah, I'll come Thursday. I'd be glad to. Thank you.
And plus, I have to say, you're the people that you introduced. We've had some really good follow-up calls. So.
Oh, good. I'm glad. I honestly don't know them that well. I met them the first time when they came to New York, but I like what they're doing.
I'll let you know. It's an interesting fund. Everybody was focused on female founders, and we're going to do more about sectors in which they're investing, including desert tech, which I have not focused on. But Lauren, you want to make a last comment before we go to Wanda?
Well, now I'm curious, William, what is your particular interest in electrification? Because that's definitely Chicago and Illinois. It's probably, they've made a lot of commitments to that, but we haven't really seen it yet. So what's your interest in electrification?
Well, okay, so
William,
yeah.
You guys.
We can talk about that offline. Yeah, I'm happy to, Lauren, because that is
a
big topic to me as well. Yeah.
Okay.
I'd love to.
So Wanda, thank you for preparing your thoughts to tell us what you witnessed, observed at the Berkshire Hathaway meeting.
If you could start the presentation, and we will be shifting from the market overview to a company overview. Very special company. 11 largest company in the world and the 6th largest company in the US. My interest are usually, so I went to the annual shareholders meeting for a number of reasons. One, my primary interest was in the governance, and this is the company like no other company. And the governance is pretty much set up by the culture. You cannot discuss the governance in the vacuum. That's why I will be sharing few slides from the financial analysis of the company. And Stephen, I was not aware of any Berkshire analysis that you guys have, so I'm using Empire Research, Whitney Tilson analysis. If you have any questions regarding technical intrinsic value computation, I'd be glad to pass it to Whitney for further discussions. But in terms of the overview, so for This particular Empire Financial Research, this is an ideal value stock. It's safe, it's cheap, it's growing. Can we move to the next slide, please? We will be addressing these three concepts more. The stock price as of the end of Q1 was for Class A, 400, almost $85,000, and for Class B, $322. For those who do not follow Berkshire in detail, Class B were introduced in 2010. Pretty much to bring into the shareholders a different group of shareholders that Warren Buffett and Charlie Munger wanted to introduce to their company. So we're talking about the 11 largest company in the world, with the total assets getting to $1 trillion, with the equity of over $500 billion, an incredible cash position similar to that of Apple and Google, flow of $150 billion, and the cash position $110 billion. And it, with the latest buybacks of Berkshire that Stephen alluded to, Buffett went on the buyback campaign in the last 12 months, and I think they brought back about 10% of the company, allocating significant cash and increasing an intrinsic value of the company of about 3%. So PB ratio is about 138. And this is the company that started in 1960s from almost Buffett and Munger stumbling upon a non-performing textile mill, and day by day, step by step, they grew it to this humongous conglomerate. And Mark, can we, I'm on slide B, in slide 5, can you move to slide 5?
Yep.
Which is the description of this conglomerate that consists of financial services companies, consists of hardware infrastructure, and interestingly enough, companies like Apple and recently Activision, and Apple is one of the 4 giants of Berkshire today. Moving to the next slide, very briefly, so Berkshire is this #1 retirement value stock with conservative positions. Starting from the beginning of the bubble, it only slightly outperformed the S&P, but look what happened at the beginning of the bubble, which is April 2020, where Cathie Wood's stock skyrocket. Buffett was accused of not being aggressive enough and underperformed S&P. But at one point, which was around March of 2021, these performances of ARKK and Berkshire intersected and reversed. So when ARKK, Cathy Woods, the growth stocks are bleeding terribly, Berkshire is outperforming on this Buffett, which is attributed to the fact that their portfolio is, so to speak, independent or resilient to economic cycles. Moving on very quickly, the composition of the portfolio is peculiar. So there are financial services. Insurance used to be a cornerstone of Berkshire. It's not anymore. I will be talking about that later. And infrastructure is has a very strong position. An interesting point on this slide is such that non-insurance earnings per share are increasing proportionally. On the next slide, the importance of float. So part of the presentation during the Berkshire meeting was the importance of cash and their commitment, their meaning Munger and Buffett commitment to having sizable cash as the indicator of the health of the company. On the next slide, we have the Berkshire Q1 22 earnings report, which interestingly enough was released on the day of Berkshire meeting at 7 in the morning. I will be sharing that later. So the net operating business rose over 15%, where SAP dropped, I believe, 12% or 17%. Don't quote me on that number. An interesting point from here is, again, the cash position dropped, but dropped only to $1.6 billion, and dropped because that cash was used for buybacks of approximately 10% of Berkshire stock. In the last 2 years, Buffett invested in not only acquisitions, but in stocks. So in 2019, Berkshire purchased approximately 5.5% of Apple, which is interesting to me from two perspectives. Buffett was known from saying, I don't invest in what I don't understand. That was at the beginning of digitalization. And he was accused of missing on this wave of growth for Microsoft and like companies. Apparently, his understanding of digital economy evolved. I suppose the close relationship with Bill Gates contributed to that. So Buffett is bringing that digital segment of the economy to the portfolio. He also revealed that he purchased about 9.5% of Activision before Microsoft made that big announcement. So definitely he's increasing the portfolio in those digital stocks, still feeling very strongly about the Bitcoin area in this whole space where they don't want to touch it. He spent about 30 minutes during Q&A session explaining why in economic terms he does not believe in cryptocurrency as the future of the market, but that is the separate discussion. Moving to the next slide, Berkshire earnings and investment per share grow, and I will go quickly through the next slides. Again, financial analysis is available, and I'll be glad to share that in detailed financial analysis. The slide number 20 points into this buyback campaign, which is highly price dependent, and it's based on the computation of intrinsic values of Berkshire that, according to the financial experts, Berkshire traded at the end of April 11% below intrinsic value. That did not include the Buffett factor. If Buffett factor is factored in, it will be even cheaper. And then moving on to my part of the presentation, which is I'd like to share my thoughts on this company at the end of the area, meaning the elephant in the room is such that Buffett celebrated his 91st birthday last year, and he will be 92 in just few months. Charlie Munger, his long-term partner, was 91, and
An impressive picture. The Berkshire Hathaway Tribe, April 30, 2022.
Right.
You gotta be kidding me. That's the meeting. That's the meeting.
That's the meeting.
That's
and
a football game. That's a basketball game audience.
Exactly. So that is the reason I wanted to attend. That is the shareholders meeting, which is actual the tribal meeting of this very unique company. It takes place in Omaha, Nebraska. The whole celebration lasts for the entire weekend. There is 2 days shopping extravaganza of all the products and companies that are showcasing their products and services, and the good deals are extended to attendees. This particular place holds up to 40,000, it has 40,000 seats. Were there 40,000 attendees? I'm not able to confirm that, but it's close to it. Before the meeting and after the meeting, there were numerous picnics, dinners, presentations. What surprised me most, I think, was the profile of attendees, which were, the whole families, very diverse group, many young people. That meeting is being called the Woodstock of Capitalism. And it showed this profile of young capitalists being male and female, and a great number of diverse participants. So moving on, the next slide. Do we have Buffett on the next slide?
Yeah, transition risks.
Oh gosh, why did I change the presentation? Before I get to that transition risk, I wanted to mention that Buffett sends his famous letters to shareholders. In the last letter, he emphasized that Berkshire is not a financial institution. In fact, Berkshire owns and operates more US-based infrastructure assets than are owned and operated by any other company in the US. And in the accounting terms, that accounts for $158 billion, billion with capital B, of property, plants, and equipment, which is a very different picture of Berkshire than it used to be. In that letter, he also emphasized that last year Berkshire paid $3.3 billion in taxes. He was very proud of that and mentioned to the shareholders how proud they should be that they are supporting almost 1% of the US Treasury. He also indicated that there are 4 pillars, main pillars, that are responsible for Berkshire earnings per share, and that are the fully owned subsidiaries. Apple is one of them, railroads, and energy. And again, he emphasized the importance of cash and share repurchase, increasing the value of the company. Interestingly enough, he did not address anything about morality or immorality of buying back shares, although he participated in that discussion at the beginning of pandemics. So now the elephant in the room is the fact that between Buffett and Munger, there's 190 years of experience and wisdom. And the question is, what will happen after Buffett steps down? Buffett mentioned that frequently he's asked this question: what happens to Berkshire after you will be hit by the bus? His response is, most likely the shares will drop approximately 10%, which is a great opportunity of buying back. And this is what we will do. And the company will prevail because of its strong culture. You saw this picture of football stadium. For 6 hours, Buffett and Munger addressed the audience with all kinds of questions, from cyber risk, nuclear risk, to depression, recession, cash position. It was amazing and surprising to see how sharp these 2 individuals are. In terms of transition, Buffett mentioned at the beginning that if he is to go, although he was in a great shape, probably a compliment to his diet of Coke in hamburgers in Omaha, but according to the life expectancy calculator, the life expectancy for Buffett is 97 and more. So he enjoys his job. He enjoys showing to work every day. So as the transition for the company continues, I think I hope to enjoy 5 more years of his salesmanship, wisdom, and unprecedented approach to governance. So again, from my perspective, this company, who employs today between all subsidiaries probably about 400,000 employees, does not have general counsel, does not have human resource manager, does not have any processes whatsoever. This company very proudly is based on the culture underlined by trust, probably in the words of Charlie Munger, over trust, and delegation short of abdication. So as we are in the transition of power, the question is, will the new team be able to maintain that culture? And will they be treated the same way by the shareholders? I'm watching the time. My time is almost up. So I share one other observation. For the last 10 years, Buffett cultivated the shareholders basis very carefully. But within the last 5 years, the shareholder base changed significantly because of the rise of passive funds who are taking positions in Berkshire. At the present time, approximately 25% of the voting shares are controlled by BlackRock, CalPERS, and other companies that Buffett did not disguise his dislike of undue influence or on governance of those passive funds that push the proposals that are irrelevant to the culture of the company. And we can have a discussion on that. One of the proposals requested Berkshire to have transparency and diversity. Only one of the out of 64 companies submits the report on diversity. The argumentation and CalPERS stand behind were one of the shareholders who voted for that proposals and submitted that proposal. Buffett's response was unusually personal. He said that he understands that in this white male-dominated culture, he himself enjoyed certain privileges that his sisters, who were as smart, if not smarter, would never be able to enjoy. And he said something to the effect, if I were born Black or in another country, I would never have enjoyed the life that I do enjoy right now. Having said that, I'm committed to the principle of diversity, and that was visible in the board, composition of the board. However, we will not impose on our subsidiaries any requirements regarding diversity. It's embedded in their culture. So fascinating discussion. The next year meeting is already scheduled for May 6th. Again, that's the weekend of celebration, and I will be there, and I invite other 360 board members to be there. There is a fascinating cultural shift and also leadership shift. The new CEO is being named, and he will share his position, the current Buffett position, with 5 other individuals. That's a totally new layout for the new company. It is 12:03, and I will stop my comments here. My apologies for my technical IQ level being at the level of my refrigerator temperature today. I will improve later. Stephen, but not Stephen. Back to
No,
you.
Wanda, that you got a lot of content there. And what questions do we have for Wanda? For some of the things that she shared.
Applause.
Wanda, I've got a
thank you.
question for you. Thank you for the presentation. I know very little about Berkshire, and that picture in the stadium was really quite fascinating. In those meetings, do they ever? It's all about Munger and Buffett. You never see anyone, younger coming up and coming, unless there's a controversy over them. I mean, there was one a few years ago that had to resign because of some conflict of interest. Otherwise, in those meetings, do you meet any of the back office, background people? And are these the people that may be taking over later on?
So Adam, that question is in the heart of why I have decided to go there in person. That culture that is based on those two iconic figures, Buffett and Charlie Munger, who is a genius in his own space. And there are books dedicated to Charlie as well. As they age, as I said, the elephant in the room is what will happen with this culture based on these two individuals after they will be gone. In my presentation, I have discussion about the risks, but going back to your question, during the first Q&A part of the session, first 3 hours of the meeting, the stage was shared with Greg Abel, who was named the CEO last year at the last meeting, and another individual, Jait, I have forgotten his last name. He's the head of the insurance. So the story more or less went like that. There were these two contenders to the top seat. Last year, the board have picked Greg Abel as the CEO. He's the head of energy. MIT, PhD, tremendous credentials, in addition to spending with Berkshire number of years running the energy business. And Jait addressed also the questions about risk in the insurance business, including nuclear risk. So someone from the audience asked, what's the scenario for nuclear risk? After rambling for about 5 minutes, Charlie Munger said, well, pretty much we don't have a scenario, but here's what I will do. In the case of nukes, I go under the table, kiss my ass goodbye, and we'll wait for what will happen. To which Buffett responded, and if regulators will have problems with this scenario, well, there will be no regulators. So that's anecdote about how these meetings are conducted, but the point is there was in-depth discussion about the risk. Greg Abel, the current CEO, for example, disclosed that every day there are about 1 million cyber attacks on all facilities of Berkshire, and they have quite strong firewall. Up until now, there were no major disruptions, few minor incidences, but that indicates how realities are changing. And the big question that is on the back of my mind, can they sustain that decentralized structure in the face of the challenge of consolidated cyber risk? That will be, I will be following that. So Adam, directly to your question about will we meet? Yes, all of the managers, top managers of the companies are available. They talk to the shareholders. They have their own meetings. On the stage, there were those 4 individuals, but during this shopping extravaganza, you could socialize with Geico people, top Geico people. You could talk to the airplane people. Just amazing, amazing gathering of what I call the tribal meeting, like Apple used to be under Steve Jobs.
Last question.
Wait, Adam, sorry, Michael had his hand up.
Oh, okay. Sorry.
Go ahead, Michael.
Thank you. So, Wanda, this is more of an impression question than a hard answer question. with the two contenders on the stage with Buffett and Munger, what's your sense? Whichever one is picked, do you think the other one will stay with the company or move on?
In the presentation that I wasn't able to show, I actually have a slide addressing that. Like in the case of Jack Welch stepping down, and there were 3-year competition for a top spot at GE. What happened was the top guy stayed inlet, and the 2 others assumed positions with other companies, which is the real risk for Berkshire, because Ajit, who runs the so factually, Greg Abel was picked up as a CEO, but he will be supported, or the executive team also consists of 2 chief investment officers, the role that is being played by Buffett right now. And Ajit, the insurance person, reports directly to the board and not to the CEO. So we have this convoluted structure that is designed to keep both individuals in place. To your question, I also look up Ajit. He's been given multi-million dollars, I think something in the neighborhood of $80 or $100 million bonus to stay with the company. And I look for body language, which you should never rely on. But these 2 individuals, Greg and Ajit, interacted quite nicely, actually. Do I believe that they both will stay? Well, first of all, that's one of the reasons I intend to be next year in Omaha, Nebraska. I'm a shareholder, so I keep my fingers crossed that the company with its culture will continue to not only exist and grow. And yes, I do hope that in their wisdom, Buffett and the board created a structure that would tide Ajit either through intrinsic motivation, external rewards to stay with Berkshire. That's my personal view.
Thank you.
Adam, you want to?
Yeah, Wanda, thank you, Mark. Wanda, what is the age of these 2 individuals that are contending for the top job? And what is the age of, I'm trying to get a feel for, how old is the management team? Are they of the same generation as Buffett and Munger, or are they?
So there are 2 questions, or 3 questions, actually. First of all, they are not contenders. They've been named by the board and assumed the position of CEO and the vice chair for finance and insurance. So these positions, they are locked in these positions. Now, their ages, I would say, upper 50s, early 60s, perhaps. That is to be verified. But you asked very important other question, which in my opinion is the real risk for Berkshire. So Berkshire is, the culture is based on those personal relationships that Buffett has with other managers. And to the point that, again, there are no processes, no procedures, almost unchecked independence if there is agreement on the values. There are 84 of those managers that are very comfortable in their positions. They are well taken financially for the next 3 generations. And the question, the real business question is, if Buffett leaves, will they continue to work very hard as they do right now, or will they decide to step down in Buffett's absence? And that is to be seen. My expectation is such that, you know, we have 5 years of Buffett reign, I hope, or even more, and more of that transition in the second level, at the subsidiary level, is going to take place right now. So my expectations are also that as institutional investors will gain more power in terms of voting shares, they will put more pressure on disclosure and processes which will naturally change that culture. There has been an attempt of bringing young people. Buffett is well aware of that, but again, he trusts the wisdom of the board, very interesting board. He instructed the board that in the case the board notices that he is losing it, whatever it means, making bad investment decision, or however board will clarify that, the board is empowered to take away the key from Buffett. And that has been repeated openly to this audience many times. So there is, the transition goes on many different levels. And the aging of the company is naturally one of those issues that are being discussed openly.
Thank you, Wanda. Very interesting.
Perhaps if you are interested, I can send that other presentation when I included more caveat on that transition, because I think the transition that is to continue will determine the future of the company. Again, I'm the shareholder and very happy one with the performance in the last few years. So the expectations from the street are such that Berkshire will continue to outperform SAP by 2-3%, which I intend to keep my position. And if you have 1 more minute, I can share that my personal investment thesis is such that I support the green transition. Berkshire bought in the last 3 months a sizable position in Chevron, which caught me by surprise. And Charlie Munger has this view of America in the next 100 years as America driven by oil. And that's their push into the energy sector. So their purchase was not opportunistic, like, you know, most short-term and mid-term portfolio adjustment. It is a long-term view on America, which I personally do not share. I see the economy based on electricity, electrified, and the transport based on autonomous vehicles, which is not what, again, these 2 individuals see, at least Charlie Munger. So I will be watching carefully.
Thank you.
Thank you for listening. Any other questions? I think only a few faithful state. It's fascinating event, even if you are not interested in Berkshire, just to see the energy, the commitment to the ethos of one person. That's absolutely fascinating. So see you next year in Omaha, Nebraska.